All right, once again, we are going to take the lecture on the next topic regarding the series of financial management, and this is going to be regarding leverages. So, now today we are going to talk about leverages in detail, and there are some prerequisites for understanding the concept of leverage. So, these prerequisites includes all the previous chapters regarding the financial management about which we have already delivered you the video lectures. So we have talked about in detail regarding objectives of financial management. After that, the we have talked about capital structure as well. We have talked about cost of capital as well. So now this is the term of a ton of leverages. Okay. So I hope you would have enjoyed the capital structure theories in which we have talked about trading on equity or debt and equity mixture. Our purpose is to find the optimal uh, balance or the optimal structure of debt and equity was only to generate or obtain two kind of objectives, to achieve two kind of objectives. So these objectives were, first of all, we have to maximize the value of our firm, and we have to try our best to minimize the overall cost of capital of our firm. As far as the overall cost of a capital is concerned, I hope you would have completely understood the concept of a cost of a capital in the previous video lecture. But now we shall be talking in detail how you can use the leverages, that is trading on equity, so that you can maximize the earnings required or the wealth of your shareholders, because this is the second and most important objectives of financial management. So we shall be talking about what do we mean by financial leverage, then operating leverage, and finally the combined or super leverage. So financial and operating leverages tell you how you can use fixed cost funds and fixed cost assets so that your ultimate profitability or wealth of your shareholders can be maximized. So this is just the introduction of that. So we shall be talking about working capital leverage as well. Number of things are there to understand. And I hope you would enjoy that. Now I'm just going to share the screen. You have to see that and you have to understand each and every word carefully being spoken by me. Just see the screen and enjoy. This is the next lecture going to be in the series of financial management I have. I hope you would have gone through from all the previous lectures. Recently, we have delivered the lecture on cost of a capital, for which we have studied all the details regarding what's that, how these are calculated, and what are their relevance for us. Okay, so with saying all these things, I taught you while teaching that concept that we shall be studying leverage after the cost of a capital topic. So regarding cost of a capital, we have talked about of a lot of things. Okay, so for understanding the concept of leverage, what you have to do, the basics or the prerequisites are the video lecture for capital structure and cost of capital. So these two are the most important chapters which are to be understood first. Only then you can expect the leverage concepts to be cleared smoothly. So just going to move further with the slides. Now we are going to talk about the leverage. Okay, so for going to the concepts of leverage, the most important thing is to understand this table, which we have talked about for number of times while studying regarding the different theories of capital structure and the system of mixture of debt and equity. So if you have the knowledge of this particular table, then ultimately understanding the upcoming concepts and the leverage becomes very easy for you. So just recall this table. Okay, so the first is the earnings before interest and tax, which is usually your operating profit or net profit. So it is written in the first equation, and after that interest is deducted from this value, and this interest is the interest which you have to pay to your debenture holders for using their money. And when you have deducted this interest from earning before interest and tax, the value you get is earning before tax. Okay, so earning before tax is the value which is calculated by having deducted the interest from the amount of earning before interest and tax. And when you get this value, you have to calculate the tax on that, and after calculation of the tax, this is to be deducted from the earning before tax, and whatever is the balance, whatever is balance, you have to write this balance here, and this balance should be divided with the total number of equity shareholders, and when you divide this, you can get the value of EPS, that is earnings per share. So this is all about the idea of how this specific table goes about. So now what we have to do, we have to understand the concept of leverage, and I shall tell you what's the relationship of this specific table with the different degrees and different concepts of leverage. So what do leverage actually mean? Okay, so you have employed the funds from different sources. Okay, you have employed the funds for your business from equity and debentures as well. Okay, so sometime when you have an asset, okay, I'm not asset, not typically that. Okay, so we can take some other examples, like if you wish to increase the return of a specific investment, if you wish to increase the return of a specific asset, then sometime you have to add some other investment in your portfolio. Okay, in your portfolio. What I am telling you that, why I'm telling you that, first, sometime in order to increase the overall gain, in order to increase the overall gain from specific investment avenues, you have to add some other assets in your portfolio as well, so that your overall return or return available for specific investment could grow up. Okay, so using some other investment options along with your current investment option is known as leverage. Leveraging the situation. Leveraging simply means taking benefit of the low cost investment opportunities, so that these can increase the values and the return for the high cost investment opportunities. So this is just that. Okay, so just giving you very short and very simple example, when you use a debenture with equity, okay, so ultimately it helps to increase the returns for equity shareholders if you are using more and more debt in your capital structure, because ultimately it increases the value of earnings per share. So this is the first example of leverage. But leverage is associated with two kinds of risks. Okay, two kinds of risks you have to understand before understanding the concept of leverage. After that, I shall be teaching you what are the different types of leverage, which is very important from our exam point of view. So the first is financial risk. Okay, so financial risk is what kind of risk that is related to financial leverage or debt financing. I am not going to talk about financial leverage right now, because whenever its time shall come, we shall be talking about this in detail. So when you have issued debentures, okay, then obviously this is the obligation to your company that you have to pay them the required amount of interest. So as you have to pay them the interest, so this is the obligation, so you cannot avoid it ever. Okay, so in case you are using high level of debenture in your capital structure, that means that if you are not earning sufficient money, then you will have to suffer huge losses because of this interest payment. Okay, so that kind of loss or that kind of risk is known as financial risk. So companies' financial risk is related to companies' use of financial leverage and debt financing. To determine companies' financial soundness is the debt and equity ratio, which measures the relative percentage of debt and equity financing. So debt and equity ratio tells you total liabilities and shareholders equity. So this ratio tells you that how much debt you have used in your capital structure in a relation to equity share capital, and that mixture should be of very feasible value. The reason being, if you are using more and more debt, then obviously you shall be having the financial higher level of financial risk. And if you use lesser the debenture, then you shall not be earning sufficient amount of for equity shareholders. Okay. So the theories suggest that, or the approaches suggest that there should be proper and optimal level of mixture for debt and equity, regarding which we have already covered the theories of capital structure. So this is financial risk. And the second one is business risk. Okay, so business risk is that risk which is not basically in your hands. Okay, so the level of a company's business risk is influenced by factors such as cost of goods, profit margin, competition, overall level of demand, services, all these kind of things. And this is categorized into systematic and unsystematic risk. Okay, so businesses risk is that risk which is not directly influenced by debt or equity mixture or any kind of these things, but this is general in nature. This is general in nature because you have to face so many kind of risks or so many kind of competition in the market. So all these competitions gradually makes up the business risk. So two kinds of risks you have understood. Now it would be very easy for you to understand regarding the leverage. So the concept of leverage is valid in business also. In financial management, the term leverage is used to describe firm's ability to use fixed cost asset or funds to increase the returns on its owner, that is equity shareholder. When you use fixed cost assets or funds, okay, fixed cost assets or funds are known as debenture. When you use debenture so that you can increase the earning per shares for equity shareholders, so that situation is known as leverage. Okay, that is known as leverage. And leverage can be further bifurcated into three categories. The first is financial leverage. uh, so there are two kind of leverages. Okay, basically the third one is composite. This has not been studied in detail in literature, but we shall be talking about that as well. So the first is operating leverage, then financial leverage. The leverage which is associated with employment of fixed cost assets. Okay, fixed cost asset, this is known as operating leverage. But the leverage resulting from the fixed cost source of funds, that is known as a financial leverage. Okay, we shall be differentiating between these two as well. And studying financial and operating leverage jointly results in the composite leverage that we shall be talking about when its time comes. Okay, so now we have to talk about financial leverage, operating leverage, and composite leverage. So what do we mean by financial leverage? This is also known as trading on equity. That simply means using debenture along with the equity share capital is known as financial leverage, and this is all about that. So financial leverage means trading on equity when you are using debenture in your capital structure so that you can increase the earnings for your equity shareholders. Then this situation is known as trading on equity or financial leverage. Now you can ask them a question. Uh, you can ask a very simple question to me: how the earning per shares will be increased if you are using the debenture along with the equity in the capital structure? Now comes the turn of this specific table. See this completely. So the first value is of EBIT and the second value is of interest. Okay, so suppose the EBIT was 55,000 and the interest is 5,000. So you are left with the value of 50,000. Okay, now you have to pay the tax on this 50,000. Okay, on this 50,000. So, but suppose you have not used any kind of a debenture in your capital structure. That means you do not have to pay the interest amount. When you don't have to pay the interest amount, then EBT shall be equal to EBIT, and that shall be 55,000. So now you have to pay the tax on this 55,000. Now you can feel the difference. In the first case, when you have used the debenture in your capital structure, then due to the deductibility of interest in the total income, your total payable taxes reduces, because you have to pay the tax on the reduced amount after reduction of interest. But suppose if you have not used any kind of debenture, then means uh, interest expenditure shall not be deducted, and you have to pay the taxes on 55,000. That ultimately decreases the earning per share. But if you are using the debenture, then ultimately that shall increase up the earnings per share, and earnings per share go directly to the equity shareholder. This is the reason why it is being said that if you use debentures along with equity in your capital structure, it can ultimately increase the earnings per share of the equity shareholder, because the basic aims or objectives of the financial management is to maximize the wealth of the shareholder, and it can be increased only in this way. Okay, so this was the complete story of trading on equity of or financial leverage. But that also comes with a cost. And what is this cost? The cost is of a financial risk, about which we have already talked about. Suppose in case your EBIT is negative, still you have to pay the interest. That means you shall suffer more and more losses. So it is also said that if you are using more and more debenture, then your interest cost shall also be more and more. And in case you have not earned any kind of net profit, but you have suffered losses, then due to this interest cost, these losses can be increased further. And if this is the case, nothing shall be left to the equity shareholder. So what should be the solution? Solution should be to find the proper mixture of equity and debenture in a way that financial risk could be reduced and earnings per share can be improved simultaneously. So these simultaneous equations, if these are followed, only then you can expect that this is the proper debt and equity mixture, and you are trading on trading on equity. So this was the whole story behind that. Okay, so the long-term fixed interest bearing debenture is employed by firm to earn more from the use of these resources than their cost to increase the return on equity shareholders. It is true that the capital structure cannot affect total earnings, but it can affect the share of earning for equity shareholder. So when these are employed, okay, so the fixed cost funds are employed in a way that the earnings available for common stockholders or equity are increased. So a fixed interest is paid on these, and this liability must be paid irrespective of revenue earnings. So this is why financial risk arises. So now we should be concerned about the impact of financial leverage, which I have already taught you. Okay, so it has two impacts. The first impact is it can increase the earnings per share, and the second impact is it can increase the financial risk for the firm as well. Okay, so using more and more debentures are viable only if the firm's earnings are greater than the interest to be paid to debenture holders. If earnings are greater, then using more and more uh, trading on equity or financial leverage is highly suggestible. So it is said that the when difference between earnings from asset financed by fixed cost and the cost of these funds are distributed to equity shareholders, they shall get additional earnings, which I have already proved in case of EPS. So consequently, EPS and the rate of return will go up. On the contrary, if the firm acquires fixed cost funds at higher cost than earnings, so if the interest is greater than the earnings of the company, then it's not viable, because company shall be losing the money. So this is all that situation. So now we shall be concerned about how the financial leverage is calculated. This is very simple. This is earning before interest and tax, which is also known as the operating profit. And when this is divided by earning before tax, then you can get the value of your financial leverage. So this is all about that. I hope you know about EBIT, that is earning before interest and tax. And when earnings are reduced from the EBIT, then you are left with EBT, that is earning before tax. And secondly, we have to study its degree as well. How much degree you are using for financial leverage, this is also to be calculated, and its formula is different. You have to remind, you have to understand, you have to cram, we can say, this formula. This is percentage change in EPS divided by percentage change in EBIT. Like from the previous year to the current year, what are the percentage of changes of EPS and what are the percentage change of EBIT? So when these are solved, this equation is solved, then you can get DFL, that is degree of financial leverage. So I hope you have got the idea of what do we mean by financial leverage. This is simply the leverage or trading on equity in which you use more and more debenture funds so that you can enhance the earnings per share or the return for the equity share capital. So this is all about that. Now we have to move further to the operating leverage. Okay, so this thing we have to study. The financial leverage was concerned with the use of a fixed cost funds, and these were debentures. But the operating leverage is concerned with fixed cost assets like machinery or some other assets which uh, occurs the fixed cost in a way that the revenue or the income from other sources could be increased. So operating leverage resulting from presence of fixed cost that help in magnifying net operating income fluctuations flowing from small variations in revenue. So this occurrence is known as operating leverage. So degree of operating leverage depends upon amount of fixed element in the cost structure. You know, in the profit and loss account on the debit side, you have to write up all the costs. Okay. So some costs are of fixed nature and some of are variable nature. Okay. So use of a fixed nature cost in your operating system so that you can increase the level of your earnings. So that kind of leverage is known as operating leverage. So this can be determined by means of a break even or CVP analysis. Marginal costing you would have gone through, otherwise we shall be talking when we shall go through from the syllabus of accounting. So on the basis of a CVP analysis, you can easily find the operating leverage. Okay. Otherwise, to find the operating leverage, you can simply say that contribution divided by operating profit is equal to operating leverage. Now, what's the meaning of a contribution? Contribution simply means sales minus variable cost. Sales minus variable cost. And when you minus the fixed cost as well from this equation, this is sales minus variable cost minus fixed cost, that is your operating profit. The numerator is contribution, and this equation comes out to be the operating profit. Now you can see that we are watching the relationship of a fixed cost elements with the variable cost element. So I have already taught you using the fixed cost assets in a way so that your contribution or your income or your return can be increased. This is known as the concept of operating leverage, and this is all about that. On the basis of that, you can easily find the break even point as well, which is the portion or which is the situation at which you are neither earning any income or you losing any kind of money. So a firm operating with a high degree of leverage above the break point that earns a good amount of profit. And when fixed costs are there, percentage change in profit will be more than percentage change in sale volume. So as we have calculated the degree of financial leverage, in the same way we have to calculate the degree of operating leverage as well. So how you can calculate that this is degree of operating leverage, that should be equal to percentage change in profits. This is percentage change in profits, and that should be divided by percentage change in sales. And when you solve this equation, you can get the value of degree of operating leverage. So why I am teaching you all these things? Okay, the reason being, in the exam even the formulas can be asked to you. The question can ask you what's the formula of financial leverage, what's the formula of operating leverage, how do you calculate the degree of financial leverage, and how do you calculate the degree of operating leverage. All these things can be asked in the examination anytime. So I hope you have got the difference. Okay, for the financial leverage, we are concerned with the trading on equity. That means using of fixed cost funds. But when we talk about operating leverage, that means use of a fixed cost assets so that your fixed costs can magnify the return or income of your concern. Finally, this is the composite leverage. This is composite leverage. This is also known as combined leverage, and some authors say it the super leverage as well. So what's that? Using both financial and operating leverage magnifies the firm. So studying financial leverage and operating leverage in combination amounts to the composite leverage. You can easily find that. Okay. So what's that? So this is composite leverage is equal to operating leverage multiplied by financial leverage. So when you have found the operating leverage and financial leverage, and you multiply these two things with each other, then it amounts to the composite or combined leverage. In the same way, like we have found the degrees of operating leverage and financial leverage, you have to find the degree of a composite leverage as well. And this is found by percentage change in EPS divided by percentage change in sales. So with all these things being said, you have now a total of 6 formulas. Okay, the first two relates to financial leverage. This is financial leverage formula and degree of financial leverage. In the same way, operating leverage formula, degree of operating leverage. In the same way, combined leverage formula of combined leverage and the degree of a combined leverage. Hope you have got the idea regarding combined leverage. This is simply the leverage which tells you that if you are using operating leverage along with the financial leverage, then they can both in combination magnify the returns or the income for the firm. And it is all about that. Now there are some other kinds of leverage, the most important of which is the working capital leverage. Okay, working capital leverage. So what's that? Use of a working capital in your company so that the returns could be magnified. So the term working capital leverage refer to the impact of working capital, level of working capital on company's profitability. So working capital, this is current assets minus current liabilities. So how do they contribute to increase the profitability of the firm? This is the study of working capital leverages. The working capital management should improve the productivity of investment in the current assets, and ultimately it will increase the return on capital employed. So working capital measures the responsiveness of return on capital employed for changes in current assets. So when you are changing your current assets, how much it is producing as a return on capital employed. This is known as the study of working capital leverage. And with this equation, you can easily understand that. So here should be the working capital leverage. I think there was some kind of typing mistake. So when we talk about working capital leverage, it should be change in a return of capital employed divided by percentage change in current assets. So when we solve this equation, we can get the value of working capital leverage. Okay. So how you can calculate the return on capital employed? This is very simple. EBIT divided by total assets. So when you solve this, you get the value of uh, return on capital employed. And regarding the current assets, this is CA stands for current assets. So this is all about that. Here again, we should have written the working capital leverage. So it can simply tell you that working capital leverage expresses the relation between efficiency of working capital management and profitability of firm. For example, current assets minus divided by total assets minus current assets. Some authors suggest this formula as well. So I hope you have got the idea regarding working capital leverage. This is simply means the use and management of current assets in a way that your overall profitability of the firm could be increased. And what's that profitability? This is just the percentage change in a return of capital employed. So I hope you have got the idea. I've taught you a lot in this video lecture. We have covered all the topics regarding the leverage. This was further bifurcated into three parts: the financial leverage, operating leverage, and combined leverage. And finally, we have studied regarding working capital leverage as well. So all these things should be bear into mind that the formula, any kind of a formula of any leverage can be asked in the examination. You must be aware of that. And regarding the practicals, you not be worried that much. If you have knowledge about the equation of all the formulas, you just have to put the values in that equation, and easily its answer could be solved out. So this was all from my side. The next lecture is going to be regarding the capital budgeting system. So thank you so much for joining me. This is Gurpal Singh from Gursur Education.